I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Friday morning. I've been waiting to say Friday morning all week. ZTTK, sunshine, ringing the bell at the New York Stock Exchange. Keepstar getting things popping over there at the NASDAQ. And look, it has been another week for the record books. While stocks are under little pressure this morning, the S&P 500 closed at a record high on Thursday and marked the index's 20th record close of the year. Investors continue to show a desire to buy dips in this market, reasoning the Fed is poised to slash interest rates in September and corporate earnings will be just fine. That's not to say investors won't dump subpar stories. Dell and Marvell Technology are hot names on the Yahoo Finance trending ticker page for the wrong reasons today. Dell showed weakness in PCs in its most recent quarter, likely as it lost market share to rival HP, and Marvell Technology served up softness in its key data center business. Guidance wasn't great either. Both stocks are getting drilled. Here's what else I'm watching right now in the markets. Number one, the Fed and all its drama. The battle between President Trump and Fed Governor Lisa Cook rages on into the holiday weekend. In the process, it sheds light into one of the biggest challenges the Fed will soon have to deal with. We'll discuss this shortly. Number two, forget tariffs at your own risk. Caterpillar said it now expects the net impact from tariffs to be $1.5 billion to $1.8 billion this year, up from a previous range of $1.3 billion to $1.5 billion. Gap slashed its full-year profit margin guidance last night due to higher than expected tariff costs. Both stocks are getting hit out of the gate this morning. And number three is the tech trade waning. Marvell Technology is out with lackluster guidance. Dell is calling attention to weakness in traditional server and PC sales. These stocks are under pressure. This is a day after NVIDIA sold off because it didn't beat Wall Street estimates by enough. Lots to get to today. Here on the opening bid roundtable, Sevens Report research founder Tom Essay, Yahoo Finance senior reporter Inez Ferre, and our very own Fed correspondent Jennifer Schomburger makes her return back to the roundtable. Jen, I'm going to come over to you here. This battle between Fed Governor Lisa Cook and President Trump it's not ending, and it's unclear when it will end. At this point, what do investors need to know about this?
Yeah, I think this is just the opening round today. We're going to have a hearing at 10 a.m. For Lisa Cook here at the D.C., the district court here in Washington. I think the implications here are, does the court system, and I think this is going to be the first of multiple rounds, I think this case will make it to the Supreme Court. And the big question on the table is whether the courts redefine what for cause stands for. This is a test of presidential power. Do the courts make it easier for a president to remove a member of the Federal Reserve Board, which would be a slash to central bank independence? If we rewind the clock back to May, the Supreme Court moved to essentially insulate members of the Federal Reserve Board, including the Fed chair, from being fired by the president. So it's really going to be interesting to see how this plays out if they uphold what we've seen in previous legal battles for the definition for cause, which is negligence or malfeasance.
Tom, you know I'm an avid reader of your work. I'm reading your work this morning, the note that came right to my email inbox, and what you wrote really caught my attention. You said, quote, the Fed is facing a troublesome and delicate policy dilemma this fall. Walk me through that.
Yeah, absolutely. So the Fed, if we get back to sort of the hard economics of it, right, and sort of step away from the political drama for a minute, the Fed is in a bit of a vice here. Right. There are certain Fed governors, in pretty much Waller being the most prominent, and he was dovish again overnight, that are focused on the labor market, and they are seeing labor market deterioration. Now, it's not so bad yet that we think the labor market is contracting, but clearly it's going in the wrong direction. I think that'll be further echoed next week in the jobs report. At the same time, prices are rising. Right? How fast they're rising and how much they ultimately rise, we don't know. We're still trying to figure that out. But they are rising, and inflation expectations are rising with them. This is essentially the worst possible spot for the Fed to be in. Add on to it the immense political pressure to cut rates that's being thrown on the Fed. And in some ways, they're looking at a no-win. If they cut 25 basis points and say, well, that's just sort of a cut to placate everybody, then that's not going to be good enough for the market expectations. At the same time, if they don't cut, and we see a really bad jobs report next week and an even worse one the week after that, everyone will get mad at them because they're behind the curve, just like they were behind the curve on inflation. This is about as tough a spot as I've seen the Fed in my multiple decades doing this.
Tom, I'm going to roll the dice here. I'm going to say the Fed does cut interest rates in September. If they were to do that, does that risk sowing the seeds of runaway inflation in 2026?
I don't think one cut does it, because I think most all of us would agree that rates are probably restrictive where they are right now. And yes, are tariffs causing some sort of upward momentum on prices? Yes, we don't know how much yet, but it's obviously starting to show up. And as we all of us have sort of said, if Walmart has to raise prices because tariffs are forcing it to, then everyone is going to have to raise prices because tariffs are forcing them to. I don't think one cut does it, but if you get 100 to 150 basis points of easing over the next year, that could, depending on what happens with tariffs.
It has been a tariff wake-up call this week, and as you had the PCE out this morning, accelerated a little bit month over month. You had Gap out last night warning on the full-year impact to its profits from tariffs, and Caterpillar warning about higher than expected tariff costs. And it's about time the market pays that attention to this stuff, no?
Yeah, I mean, but you still have consumers that are spending. You just have this K-shaped economy that we've been talking about, where you have the higher income spenders that are really keeping the economy going, and then the lower income spenders that are getting totally squeezed because they are feeling the impact of tariffs, of inflation. And you've got this that is across the board when it comes to the retail space. You also have furniture now that is going to possibly get tariffed as well, furniture imports. So there's a lot going on the tariff front, yet you are still seeing the markets at all-time highs, and investors have still been buying the dip. I mean, we just had the S&P 500 crossing 6,500, and you still have Wall Street that is expecting this rally to continue into the end of the year. September may be a little bit shaky because of seasonality and such, but still, you have Wall Street that has been very bullish on this rally.
Brian, can I jump in?
Yeah, Jen, actually, yeah, go ahead.
I just want to respond to everybody here talking about the impact of tariffs on inflation. You know, it's interesting because I was sitting down with Jeff Schmidt, who's the head of the Kansas City Fed in Jackson Hole, and he's actually not too worried about the impact of tariffs on inflation. And that's the sense I'm getting more and more from certain members of the Fed. He's actually worried that if the Fed were to cut rates, that would ignite demand. He thinks that demand in this economy is still strong. Certainly, we saw that borne out with the revisions upwards in GDP for the second quarter. Consumption was revised upwards. And today, personal income and spending was very solid. So you could make the case that does the Fed really need to cut? But as the guest also said, the Fed also has to watch the labor side of the market. And Chris Waller gave a speech last night, Fed Governor Chris Waller, in which he made the case for a 25 basis point rate cut in September, noting that he thinks we're going to see further revisions to the downside from what we already saw, and that job growth will likely turn negative for the past 3 months. He says he's fine sticking with 25 basis point cut for September, but if things look worse with the jobs report for August, which is due out on September 5th, then it sounds like there could be more on the table for him. And we also heard overnight that the Senate Banking Committee has scheduled a nomination hearing for Stephen Marin, Trump's nominee to replace Adriana Kugler's seat. So if by some Hail Mary, he is confirmed on the committee by September 16th and 17th, then that's going to be another dove voting in favor of a rate cut here. Powell's clearly opened the door for that. So between now and September, unless we get a very hot inflation report on CPI on September 11th and the jobs report rebounds, you know, I think the Fed, like you said, is set to cut. The bigger question is what happens after September?
Tom, let me tap you in here and get into your trader mind. We start getting negative reads on the jobs report. And I don't know if we're going to get it next week, but if we start to get some of these negative reads on jobs like Jen is suggesting, is that market correction worthy, or investors are going to hold out hope that even with negative jobs reports, we're going to get rate cuts, and that's usually good for stocks?
I don't think one would do it, but if you get a negative jobs report, if you get the ISM PMIs moving down to 50, I think all of a sudden economic anxiety pops. And as we've all been discussing, this market has zero room for error at 6,500 in the S&P 500, right? And so the idea that the economy could just stall, let's say 0 to sub 1% GDP growth, is nowhere close to priced in. We could drop 10%, it still wouldn't be priced in. So I think that a growth scare does create a correction, say not a correction, excuse me, a pullback, 5 to 10%. If we get multiple months of negative jobs growth, and all of a sudden we have to talk about the stagnation in stagflation, then I think a full-blown correction is absolutely on the table.
And as I'm going into this weekend, obviously going to be focused on all things the Fed, but I'm really wondering if we have reached some form of short-term peak in the AI trade, more broadly even the tech trade. Marvell Technology didn't like that guidance, didn't like what Dell had to say. You saw NVIDIA sell off on its modest earnings beat. There's some clear signs here that there might be some fatigue in tech.
I mean, yeah, there are some signs or concerns about the AI trade and whether it's really, whether all the participants within the AI trade are seeing growth. I mean, with Dell, it seemed like a lot of the issues that they had, according to what the analysts have been saying, has been with execution, and that has sort of pressured margins, expedited shipping, also pressuring margins with Dell. You still have analysts that are pretty bullish on the Dell story. Marvell is a little bit different. That stock is down year to date. But I think that what the street is looking at is overall growth going forward. I think NVIDIA, despite its stock performance yesterday, which was only down 0.8%, I mean, you still have investors that have been buying the dip on NVIDIA, and Wall Street that is just salivating at this idea that, okay, $3 to $4 trillion of AI infrastructure spend through the end of this decade.
Jen, this is the first time I've seen you since Jackson Hole. I mean, I loved your coverage, but I mean, did you see any wild animals out there? Any bison? I mean, what did the wildlife look like?
Brian, I was very disappointed this year as I was glancing over the savannah, you know, my view from my office last week. I did not see many an animal, but I did see some bison on the drive back to the airport. And I had the opportunity actually to go to a ranch where I saw how wild horses are tamed, which was a very interesting experience. They had a horse whisperer, if you will, there. So that was some Western culture there from our United States.
I'm really controlling myself right now to not make horse noises on Global Live TV. We're going to leave it there. Again, this is Best in Class Roundtable. Head into the weekend. Thank you all. Appreciate it. All right, straight ahead, I talk with Gap CEO about the company's quarter and more cautious outlook. We'll be right back with that one. Shares of Gap are under a little pressure as Trump tariffs forced the company to mark down its full-year margin guidance. The guidance week overshadowed continued sales success at the Gap division and what looks to be a long-awaited turnaround at Banana Republic. I caught up with Gap CEO Richard Dickson to get the why behind the numbers.
We have a good story to tell with Banana. It is an ongoing progressive story. We've been focusing on reestablishing the brand in the premium lifestyle space. And our quarter performance at 4% comp really shows and reflects the significant progress that we've made against that ambition. We've tightened our assortment. We redefined our product aesthetic. We've enhanced our marketing campaigns. You could see it out there with storytelling, even on our sites. And we've improved our service levels. So this quarter was meaningful improvement progress that we made also in harmonizing the look and the feel of both men's and the women's product lines. It's created greater alignment in design and merchandising, and it's unified storytelling. It's showing up in all of our platforms as we talk about the brand. We've seen particular strength in the women's business, on the bottoms business, which is an important category in relation to wardrobe building, and it's been central to our strategy. As you know, men's has been performing well, and I'm really pleased now to see the women's business start to catch up. We've done a lot of work on what we'll call brand codes. That is a really important part of keeping a brand unified. So lots of work, lots of progress. And with each quarter, we're starting to see clear signs that the brand is really coming together. I think our Q2 performance really demonstrates meaningful traction as our playbook gets executed and the reinvigoration starts to really take hold. I'm very pleased with the progress.
Gap sales, as I mentioned, seventh straight quarter of positive comparable sales. This is an interesting moment in retail, Richard. There's a lot of unique partnerships going on between celebrities and retail brands. Are you surprised that those partnerships are cutting through what is a challenged consumer? I mean, clothing has gotten more expensive, food has gotten more expensive, but here's somebody is going out there paying for a new pair of jeans because they see a celebrity wearing it on TV.
Well, first of all, good brands are good storytellers. And Gap is continuing to deliver strong and consistent results because we're executing really well against our playbook with consistency. Brian, you're calling it out. This is the 7th consecutive quarter of positive comps for Gap. 4% this quarter is on top of a 3% comp last year. It is consistency with a brand that is now setting new records. And it's reinforcing our confidence that this brand has great growth trajectory. The playbook is working. Our latest example is Better in Denim. I mean, this campaign, which launched last week starring Cat's Eye, it has driven record-breaking response for the brand. Early reads, I would tell you, Better in Denim is striking a range of being one of the most iconic brand campaigns out there. People aren't just watching, they're actively joining in suggesting this is not a cultural conversation, it is a cultural takeover. This has all the elements of Gap global phenomenon. And this is where, and we've talked about it, fashion meets entertainment. Fashiontainment is essentially what's driving a lot of consumer connectivity. And the brands that get that story right are seeing it resonate, and Gap is certainly getting it right.
Last time we talked for earnings before Cannes, you put out a range for tariff impact, Richard, 250 to 300 million tariff impact for this year. I didn't see that on the earnings release. Is that still the number people should use? Because just crunching the numbers on your operating margin guidance, it looks to be a little bit lower than it was before.
Yeah. Well, first of all, Brian, I just want to give a big shout out to our team. They've been driving incredible focus and discipline as we continue to deliver on our commitments. We're now thinking about tariffs more in terms of net impact. That's also because of the progress that we've been making with our mitigation efforts. So with that in mind, we estimate a net tariff impact of approximately 100 to 110 basis points to our operating margin. That's about 150 to 175 million to fiscal 2025 operating income. This has already been embedded in our guidance. And as we pursue mitigation plans, we remain focused on sustaining the momentum and the market share gains that our reinvigoration playbook is driving. And look, these are circumstances we are all dealing with, but what we need to make sure, particularly in our portfolio, is that we are not compromising the long-term integrity of our strategy, and our customer value proposition remains intact. Again, incredibly proud of the team's focus and discipline, and as we pursue, moving forward into 2026 and so forth, we believe we'll be able to mitigate all of the tariff impacts moving forward.
All right, let's fire up my question today, and here it is. We're going to stay on retail. Earnings out of apparel makers this week, such as Gap, Abercrombie & Fitch, and PVH, weren't too shabby. I've been pleasantly surprised by how these businesses are holding up against tariffs and more cautious shoppers. So with this in mind, who stands to be the big apparel winners into year end? Neil Saunders is a managing director at GlobalData Retail and joins me now. Neil, always nice to get some time with you. You probably just heard Gap CEO Richard Dickson talking about his quarter. What we didn't get to in there, and they talked about in the earnings call, it sounds like Gap is about ready to raise prices because of these tariffs. And that's a big shift to what they were doing in the first half. How do you think consumers will take these price increases, not only from a Gap, but I imagine a lot of their competitors?
Well, it's a great question, and it's one that we're all holding our breath for. We're waiting to see how the consumer will respond. I think in general terms, though, there is not much headroom for price increases as far as the consumer is concerned. The consumer has just come off the back of 2 years of being battered by inflation, and they're not really in a mood to have prices go up further. Now, that said, it depends where you are in the market. If you're a strong brand, if you're doing the storytelling that Richard was just talking about, if you have must-have product, probably fine, you can get away with some price increases. If you're in the middle market, you're murky and not really a must-have, you're going to get killed by putting up prices because all it is going to do is push down volumes. So I think that's why we're seeing a lot of caution from retailers, and they're sort of trying and testing to see what they can get away with.
Depending on the category, Neil, I think consumers generally are doing reasonably well. Not everyone, but reasonably well. We see in the economic data. I think they can handle a 2, 3, 4, 5% price increase on a pair of jeans. But just given how tariffs have come up so significantly in some cases, depending on product, are we looking at potential double-digit increases on certain apparel items for the fall and then the holiday season?
Well, if you take the tariff rate and you filter it through into what should happen to prices, we're absolutely looking at that kind of level of increase. But this is the interesting thing. Tariffs increase costs for US retailers. There's no question about that, whether you agree with tariffs or disagree with it, they increase the cost. But how does that come out of the wash? Well, it can come out in one of two ways. It either comes out as a price increase or it comes out as a hit on margins. And what we're seeing and hearing from retailers is that there will be a mix of these things. Not many retailers are coming out saying, hey, we're going to pass everything across. They're really cautious about doing that. So what we've heard is from Abercrombie and Fitch, for example, Fran Horowitz has been really clear. She said, we're really happy with our value equation. We don't want to damage that. So we're really looking at absorbing some of these cost increases, maybe finding other ways we can save money so it's not got too much of a hit on margins, so that we don't have to pass all of that across to the consumer. And I think that's the interesting thing. We always talk about the inflationary impact. Well, yes, there is an inflationary impact, but don't forget there's also a profit and earnings impact as well that comes out of this. And it's that mix between the two where retailers are testing.
Other things going on in retail, Neil, it's an interesting moment for celebrity partnerships. And I was talking to PVH CEO Stefan Larsson a little bit behind why they have seen double-digit gains in men's underwear, up 14%, I believe, in the most recent quarter, in part because of Bad Bunny. And Neil, this stuff is not exactly cheap. I mean, you get 3 pairs of these white underwear for Bad Bunny for about $49.50. I mean, it's a pricey purchase. I mean, how much longer, can these celebrity partnerships, whether it's Bad Bunny, a Sydney Sweeney, or even a Cat's Eye for Gap, how long could they continue to work to drive traffic, and why are they driving traffic?
Well, I think they can continue to work for quite some time. The consumer has shown remarkable resilience. There's money there to be spent. And sometimes it's not about the organic growth. It's about how you can steal share from other people. I think celebrity collaborations, if they're good, do that because, first of all, they spark interest. Second, they create demand because things become a must-have product. You see a celebrity wearing it, it then enters the kind of culture and people say, oh, I must have this. It's just about creating excitement. And actually, it's really interesting because although we talk about the consumer being depressed, where the retailer offers value for money, where they offer interesting products, we see growth. I mean, Tapestry, Ralph Lauren, both have done extraordinarily well in a very difficult luxury market. So we know that there is money there to be spent, and the celebrity dimension just provides that excuse. It's that level of excitement and interest that takes products from being bland and everyday, where you say, hey, I can leave that, to a product that you say, hey, I must have this. It's something that I really, really want. And where the consumer has that, they're still willing to spend money.
I am now suddenly excited about buying Bad Bunny white elastic underwear. Neil, real quick before I let you go, I have 30 seconds. One apparel winner that you think will win in the back half of the year, whether it's sales, earnings growth, who do you think is going to do really well?
Well, I think honestly it has to go to off-price. I think TJX, Ross, Burlington, all fantastic results. They're all winning new customers. They're in the value part of the market. They're still driving great product and selection. The treasure hunt's still relevant. So I think off-price in apparel is going to be a real winner. Winner in the first half, it will be a winner in the second half.
All right, we'll leave it there. Neil Saunders, always great to see you. Have a great weekend. Appreciate it.
You too. Thanks, Brian.
All right, coming up, Ali Canal has you covered on Market Catalyst. Don't go anywhere.